Hey guys, welcome back to the channel. So today we're going over what I believe to be some of the best high-yielding technology/growth funds on the market. Now usually high yield and tech do not go together, but the way these funds do it is through a covered call strategy, and they're trying to give you the best of both worlds. So good long-term capital appreciation through the tech equities and some current income via the option strategy. So in this category, I currently have three favorites. JEPQ, or JEPQ, whatever you want to call it. You might be familiar with JEPI, that's the older sibling, but that one doesn't focus on growth and technology stocks. QYLG is another one of my favorites. This is based around the QQQ, and out of all these options, this is the most passive and systematic, which might be more attractive to different investors out there. And finally, my third option here is BST. This is actually a closed-end fund. The expense ratio is higher than the ETF alternatives, but I think it is a very high-quality option. So I hope you guys enjoyed the video. If you do, I always appreciate a like, subscribing. It really helps out the channel a lot. But let's get into this. Okay, now before jumping into the three different funds, we all know that right now, technology growth investments have done terribly over the past 1 year, but this could be creating a good potential buying opportunity for these types of funds. So of course, the main threat to these kinds of investments is the hawkish Fed. And currently the best estimation is that the hawkish Fed is going to persist into the first half of 2023 at least. But with that said, this next paragraph here goes on to say that historically, when we do turn the corner and we exit the bear market, the QQQ, which was beat up the most, is actually going to most likely recover faster than the rest of the market. So the question is, do you think we are semi-near the bottom of this pullback? We did have a positive inflation report the past month. A new one is coming out in just a couple of days. But on the other hand, the 5-year break-even inflation rate did slightly increase after the most recent employment report. So that's the unknown and the risk in this situation. You could potentially get outsized returns if you play it right, or the bear market could continue and you could lose money with these investments. Okay, so with that broad view of the market out of the way, here are my top 3 picks of these growth high yield funds. We have BST, QYLG, and JEPI. A big caveat here is that JEPI by far is the newest fund out of the bunch. It only came into existence around May of this year, so there's not a lot of historical data, unfortunately. But luckily, by understanding the philosophy of the fund, we can actually gain a lot of insights on how it might behave in the future. And speaking of the philosophy, here is the investing approach for BST. So BST is a perpetual closed-end equity fund. The investment objective is providing income and total return through a combination of current income, current gains, and long-term capital appreciation. It gives you access to current leaders and emerging winners in the technology sector, has flexible mandate investing in technology companies across various market caps, regions, and industries. And of course, it sells covered calls on a portion of the portfolio. And because this is a closed-end fund, it's currently trading at a discount, almost a full percentage point off, and the yield is close to an all-time high of nearly 10%. And this is paid out on a monthly basis. In fact, all of these funds pay out their huge dividends on a monthly basis. Something else notable about BST in particular is that it gives you access to private startups. And these private startups, aka companies not yet listed on the stock exchange, represent about 13 to 14% of BST at the current moment. And when it comes to that dividend, as we saw, the yield is almost 10%. And this has managed distributions because it's a closed-end fund. And we can see that all throughout this year, it's been paying out 25 cents per share. Yeah, it says right here that the distribution has averaged a remarkable 14% CAGR since the inception. So that's BST in a nutshell. It doesn't follow any specific index, so because of that, it's a little bit unpredictable. All we know is that the management focuses on current leaders and emerging winners in the technology sector, And the covered call strategy is also fluid based off of the research of management. Okay, the next fund is JEPQ. This is a traditional ETF, and it's from JP Morgan Asset Management. The expense ratio is a lot less than BST at 0.35%. And the goal here is to generate income through a combination of selling options and investing in US large cap growth stocks. And here's the main objective of this fund. So it seeks to deliver a significant portion of the returns associated with the NASDAQ 100 index with less volatility, mostly due to the dividend income. So that's a big difference when compared to BST. We actually have a loose benchmark, the NASDAQ 100. But then much like with BST, the management has some proprietary data science and they choose investments that way. So to summarize, JEPI should have similar returns long-term to the QQQ. But the way the ETF generates that return is through active management and covered calls. And finally, that leaves us with QYLG. This is more similar to JEPQ because it also uses the NASDAQ 100 as its benchmark. But the huge difference with QYLG versus the other two funds is that this is completely systematic. We don't have to guess as to what the management is going to do. So QYLG seeks to generate income by writing calls on the underlying index, aka the NASDAQ. And the strategy here is they write these covered calls on 50% of the portfolio, and the other 50% is just pure equity, the NASDAQ, and it can appreciate with the rest of the market. And to give you a bit more details, the types of covered calls they sell are at the money, which means there's zero room for any price appreciation on this half of the portfolio. Okay, so hopefully now we have a good understanding of the broad goals, strategy, and approaches of all these various funds. Again, you do have to keep in mind that JEPQ kind of messes this up because it's the youngest fund on this list. But even so, over the past 1 year, we can see that BST has been the most volatile, down about 39%. The dark blue line here is the benchmark, the QQQ, and as expected, the Global X QYLG is very similar to that. Even going all the way back, the price action is almost identical. And JEPQ does use the QQQ as its loose benchmark, and thus the price action is also in a very similar direction. Now keep in mind that is just the price action of these funds, but the dividend is a huge portion of the return for these kinds of investments, and for that we need a different calculator. This calculator shows the total return, so beginning with QYLG from the inception date, which is late September of 2020, and that's actually very convenient because it allows us to see how the portfolio or how the ETF operates in both a bull market and a bear market. And over this time, the return is slightly positive at 2.74%. Over the same time period, BST has a total return of negative 4.29%. And we can see in the chart here that it's way more volatile and started going down earlier than the broader QQQ. And speaking of the QQQ, over this time period, this is what the total return looks like with a positive return of 4.46%. So from that, clearly BST looks to be the worst investment out of all of these. And it is true that BST is the most volatile, but remember that volatility goes in both directions. So yes, this past year it has been down the most, but in the future, that does mean that BST could potentially have outperformance. And to get a feel for this kind of a market situation, I changed the ending date to the beginning of the bear market. So during a time like this, BST had a total annual rate of return of 15.72%. Over the same time period, QYLG was 18.5% and the QQQ 25.5%. And let's do this one more time really quick with JEPQ. Again, the time period here is very minimal, but I still want to show it to you guys. So from May 5th, 2022 to the present day, JEPQ is down 9.62%. QYLG is down 14.5%. BST 20.65%. And the QQQ 12.96%. And a final fun metric we can look at here is the ETF overlap. So beginning with QYLG and the QQQ, there should be a 100% overlap between these two funds because the QYLG follows the QQQ perfectly, and that's exactly what we see. Now, if you remember, JEPQ uses the QQQ as the benchmark, but the active management doesn't follow it exactly, and currently they overlap by 65%. So out of the individual holdings of the NASDAQ 100, The management of JEPQ is currently more bullish on these names. So if you agree with these holdings and the kind of logic here, maybe that's another valuable data point pushing you in the direction of JEPQ. But yeah, let me know in the comments below which one of these high yield tech growth funds is your personal favorite. Do you invest in any of these kinds of funds, or do you avoid them completely? That's gonna do it for the video. Hope you guys enjoyed. If you did, I appreciate a like, subscribe, and I'll see you guys in the next one.